Hello, good day. Finally, we have come to the end of September term year 2020. This is the last screencast for portfolio management for this year. This video gives an overview about hedge fund and how it operates. I hope this will give you a good outline to understand hedge fund as an investment vehicle and its basic characteristics. I hope your learning and exploration do not stop here, as the world of knowledge knows no limit. Do continue to explore and broaden your knowledge. I definitely hope to develop more detailed topics on hedge fund, its development and future direction, if time allows. Stay tuned and let's learn together. Hedge funds represent a means for a group of investors to pool financial resources to be invested by a fund manager in the pursuit of specific financial goal. The basic idea behind hedge fund is investment pooling. Hedge funds and mutual funds are similar in one respect. Both are pooled investment vehicles that accept investors' money and invest those funds on a collective basis. Both sell shares or participation in a professionally managed portfolio of securities. However, there are important differences between the two. Hedge funds are not mutual funds. They are totally different types of investment products. There are important differences in investment philosophy, regulation, establishment, investor suitability, fees, liquidity, and investment practices. We will learn about the unique features of hedge fund in the next few slides. Actually, the name hedge fund is somewhat misleading because hedge funds do not restrict their activities to hedging or reducing risk. Rather, the term hedge fund is a generic name for funds that engage in a wide range of activities in an attempt to generate superior returns. Hedge funds are set up as private entities, usually in the form of limited partnership, and as such, hedge funds are largely unregulated and not subject to many Securities Exchange Commission regulations. The general partner runs the fund and directly participates in the fund's profit, often taking a performance fee. The limited partners are the investors and consist mainly of institutions such as pension funds, endowments, private banks, as well as high-income individual investors. Hedge funds are not closely regulated as are mutual funds. This is because hedge funds are private limited partnerships that are not regulated by the Securities Exchange Commission. Hedge funds are subject to only limited oversight because they serve only sophisticated investors. The absence of scrutiny has helped hedge funds keep their trading strategies secret. Hedge funds often follow complex strategies, may effectively partake in any investment strategy, and may act opportunistically as conditions evolve. Hedge funds by design are empowered to invest in a wide range of investments, with various funds focusing on derivatives, distressed firms, currency speculation, convertible bonds, emerging markets, merger arbitrage, global macro, and so on. Some funds may jump from one asset class to another as perceived investment opportunities shift. This slide shows a classification of popular hedge fund strategies as defined by some common features. Hedge funds are open to a limited range of investors. Many hedge funds are, by choice, even more restrictive and limit their investor to only very high net worth individuals or institutional investors. They do not advertise to the general public, although the recent trend is to market as well to ever smaller and less sophisticated investors. Hedge funds traditionally have no more than 100 sophisticated investors. In practice, usually defined by minimum net worth and income requirements. The advantages of hedge fund investment include flexibility, impressive performance, and low correlation with traditional asset classes. The disadvantages of hedge fund include lock-in periods, difficulties in assessing performance, lack of transparency, the use of leverage that increases risk, as well as high management fees. Hedge funds also differ from mutual funds in their fee structure. For a typical equity mutual fund, the annual management fee is equal to a fixed percentage of assets, for example, between 0.5% and 1.5%. Hedge funds charge a management fee, usually between 1% and 2% of assets, plus a substantial incentive fee equal to a fraction of any investment profits beyond some benchmark. The incentive fee typically is 20%, but is sometimes higher. Indeed, some observers only half-jokingly characterize hedge fund as a compensation scheme masquerading as an asset class. The general partners of the hedge fund run the fund and directly participate in the fund's profit, often taking a performance fee of 20% of the profits, in addition to a base fee of 1 to 2% of assets under management. The manager gets the fee if the portfolio value rises sufficiently, but loses nothing if it falls. How does the high water mark operate? If a fund experiences losses, it may not be able to charge an incentive fee unless and until it recovers to its previous higher value. With large losses, this may be difficult. According to Bodie, Kane, and Marcus, high water mark therefore gives managers an incentive to shut down funds that have performed poorly, and likely is a cause of the high attrition rate for hedge funds. Measuring hedge funds' performance is not an easy task for three reasons. First, hedge funds often invest in illiquid assets which cannot be marked to the market regularly. This results in systematic downward bias in the volatility of their return distribution. The true underlying volatility is much higher. Second, hedge fund return distributions are different from those of traditional assets. They are more non-normal, with more negative skewness and more kurtosis. Third, hedge fund databases suffer from important biases. For example, backfiling bias, survivorship bias. There are two common types of performance measurement biases. First, backfilling bias, which arises because hedge funds report returns to database publishers only if they choose to. Funds started with seed capital were open to the public and therefore enter standard databases only if their past performance is deemed sufficiently successful to attract clients. Second, survivorship bias. 30% of hedge funds do not last even 3 years. Survivorship bias arises when unsuccessful funds that cease operation stop reporting returns and leave a database, leaving behind only the successful funds. When only successful funds are included in a database, the estimated performance of a sample of mutual funds can be affected. Therefore, the prior performance of funds that are eventually included in the sample may not be representative of typical performance. Hedge fund investors in aggregate have not done nearly as well as popularly believed. The media focus on the profits of the top managers has obscured the absence of wealthy clients. Although the industry performed well in the 1990s, it was small and there weren't many investors. In recent years, as its rapid growth has continued, results have suffered and many more investors have lived through mediocre returns, as compared with those enterprising fields that found hedge funds when the industry itself was undiscovered. Last but not least, I have found some interesting ebooks about hedge fund in our library system. I would strongly encourage you to explore and read. I hope you have gained a better understanding about hedge fund. See you and goodbye.